Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hello, hi everyone. I'm Zach from Earmark, and thanks for joining us today or watching this on demand. I'd like to welcome you to Understanding IRS Taxation of Cryptocurrency and Digital Assets. I'm going to hand it over to your instructor for today, Justin McCary. Justin, please take it away.
Hi, everybody. Nice to be with you all. My name is Justin McCary, and we're going to get started going over understanding IRS taxation of cryptocurrency and digital assets and why you should be paying attention to that first question on the tax return. First, a little bit about me. My career started in 2018. I went to Adelphi University in New York. I started my career at PwC after doing private company business taxes. During 2020, I started MacTax. Around that time, I also got involved in doing cryptocurrency taxes. That was the whole cryptocurrency started going up again, the NFT craze. And that's when people really started moving digital assets from one wallet to another. So now we're servicing over 250 clients at our firm, personal income tax, business income tax. We have that niche in cryptocurrency, as well as financial statements and more. We have a great team at MacTax. There's about four other full-time employees besides myself. That's what helps us keep growing. And fun fact about me, I ran cross-country and track in college, anywhere from the mile to the 10K. So I find a lot of similarities in accounting and running. Oh, also, as we go along, any questions that you guys have, please ask them as we go. Drop them in the comments. I have it up on the screen. I'll be taking a look as well at those comments. And hopefully, whether you are a taxpayer or an accountant, hopefully we can answer your questions and provide an overview on digital assets and what to look out for. So with that, learning objectives for today are going to be understanding what cryptocurrency and digital assets are. It's hard to do the income taxes on them if you haven't used crypto yourself. So we'll get into that. What is considered a taxable event in the eyes of the IRS? Believe it or not, they are looking into this very heavily. I'm sure some of you may already know that. Maybe that's why you're in here today. How are taxable events reported to the IRS, aside from that first question that we all may know on the tax return? And then finally, how to generate tax reports to include in your business or personal income tax returns to report to the IRS. Understanding cryptocurrency and digital assets. So digital assets, they're unique identifiable items that are sorted digitally and can be used to create value for organizations. They're stored electronically. They can be bought, sold, owned, transferred, traded, or even loaned. The tax definition of digital asset is any digital representation of value recorded, cryptographically secured digitally and distributed on a ledger, similar technology. For U.S. tax purposes, digital assets are considered property. They're not considered currency or securities. So we'll get more into that later, but basically that last bullet point, U.S. considers it property is the reason why cryptocurrency taxation is so involved and can be very time consuming, especially given if a particular taxpayer has a lot of volume of transactions, whether it's staking, trading, loans, business activity, etc. So this is a brief overview of how the blockchain works. A transaction is requested. The block is represented on the blockchain. It's also shared among multiple networks. This is kind of how the blockchain is not able to be hacked, because it's demonstrated on multiple machines. I'm not going to pretend like I'm an expert on understanding the technology, the underlying use of it. But the big point is that it's a public blockchain. And the transactions on there can be viewed by anybody, and it's a public ledger of what's gone on. The blockchain can be used to make data in industry immutable. That's the term used to describe the inability to be altered. That's the key component of a blockchain. So let's talk about an exchange, centralized exchange versus decentralized wallet. So an exchange is typically, if we're talking centralized exchanges, a crypto exchange where users can buy and sell cryptocurrencies, and the centralized exchange has accounts where they buy and sell and maintain those assets for the user, kind of similar to like a Fidelity or Charles Schwab. Coinbase, a secure online platform that allows users to buy and sell cryptocurrency, is probably the one most people are familiar with. Now, a decentralized wallet allows users to have control over their private keys and funds. This is where a platform like Coinbase does not hold and secure it. It's secured solely on the blockchain. You may also hear this as cold storage or MetaMask. So MetaMask is an example of a decentralized wallet, as well as if you buy a ledger to store your crypto on quote unquote cold storage. We can get into more of that later. That's where you move it to a wallet that is not connected to the internet, but you hold a set of 13 or more words that are just your password to get into that wallet. So it's just a long string of letters and numbers as a public wallet address. That's where users can send crypto and receive crypto. And the only way to access that wallet is if you have the 13 private words, or again, it could be more. And that's the only way to get in. So if you lose those, you're basically, you lost your money, you lost what's in that wallet. So it's totally decentralized. It's the cryptocurrency equivalent of keeping money under your mattress. It's not backed by any FDIC or anything like that, or guarantee of a centralized exchange. So there are different blockchains. There's a Bitcoin blockchain, there's Ethereum blockchain, and there's also other blockchains out there. Ethereum is what most people are probably used to seeing. Etherscan is a common one. Back when everyone was buying kind of NFTs or getting involved in staking or swapping or decentralized exchanges where you can provide liquidity to an exchange of a certain token in exchange for yield, they call it, which is the equivalent of basically interest that you earn. Etherscan is a great example of the different blockchains you can look on there, and it shows you a lot of detail of very clearly and easily, in my opinion, of if you have one address that sends crypto to another address, or Coinbase or Gemini, or if you bought an NFT on OpenSea, you can see a lot of the detail on Ethereum. And all of these blockchains have some type of a block explorer like Etherscan, where you can look into the blockchain detail and see the nature of what the transaction was, seeing the two public wallet addresses, the value of what was exchanged, as well as the fee, the network fee, otherwise known as the gas fee for performing such transaction on that blockchain. And there's competing and other different blockchains, Avalanche, which is AVAX, Polygon, Chainlink, etc. But the two main ones are Bitcoin and Ethereum if you're new to cryptocurrency. So then there's also what's called layer 2. Layer 2, from a tax perspective, poses more complicated situations in terms of gathering one's transactions. We're gonna get into that later as well. In order to properly do somebody's crypto transactions, you need to gather all the transactions from all their exchanges, like Coinbase, Gemini, Binance, as well as other decentralized wallets. But sometimes in these wallets, you can bridge it, what they call it, where you move crypto into what's called a layer 2 chain. This is a protocol, a platform where typically the fees for transacting are lower. So Token Trove is an example of one. If anyone's traded NFTs, you can look, you deposit Ethereum onto this platform, and from there you can buy and sell different NFTs without incurring any Ethereum gas fees, network fees for those transactions. So when you have layer 2 transactions, and if you're somebody who's getting involved working with people, or you're a taxpayer listening to this, it's important you share with your accountant any layer 2 transactions, because those are also all taxable events if you're swapping Ethereum for an NFT on those platforms, or NFT back to another digital asset. Cryptocurrency staking. Staking is cryptocurrency, a process of locking up crypto for proof of stake or proof of work. Proof of work is considered mining with Bitcoin, where you have a bunch of computers, they solve a problem, and it adds another block, another Bitcoin to the network, and the miner gets rewarded in the form of Bitcoin. Ethereum has proof of stake, where you deposit 32 Ethereum, and they have other smaller platforms where you can deposit less, but the main one is where you can deposit 32 Ethereum, and you get paid for depositing those 32 Ethereum with more Ethereum. Think of it like depositing money into a bank account, and you earn interest on that money in the bank. So you lock it up, you put it in a bank or a CD, and then you earn more interest on it. Crypto staking, I want you to think staking equals interest in terms of how it functions and how it's reported to the IRS. So when you receive cryptocurrency, that's that's the fair market value you have to pick up as income based on the Ethereum you receive. And we'll get more into that later. We have more slides on that, but I'm trying to already start to tie in what this is in the crypto world and how it relates to income tax. We discussed Bitcoin mining. Bitcoin mining, very similar to crypto staking in terms of you're not locking up Bitcoin. That's the key difference here, is you have a computer that solves a math problem, and the miner gets rewarded with more Bitcoin. Whereas staking, it involves locking up cryptocurrency in the protocol, in the blockchain, in order to earn more of it. Any questions so far? Might have a few people who are already familiar with crypto, so we'll try and move on to the tax part soon. Non-fungible tokens, NFTs, as you've heard them, they have all gone down a lot in value, but they can represent various digital assets. They can represent art, music, video games, ownership of a real life asset, membership to a club. I own an NFT called Flyfish. It allows me to have access to this restaurant in New York, and you can only get in to that restaurant if you have a membership. And the NFT is the premier membership that they offer. So they do have some real life functionality. And it all depends on how the project owner is using the NFT. Now, the NFT is not as tradable as, let's say, Ethereum is. It's not priced on the market. So NFT pricing and the tax implications on that are going to be based on when somebody buys and sells it. So if you bought an NFT from one Ethereum, and at that time, it was $3,000, that's your cost in that NFT. Now, when you sell it for another digital asset, you're going to base your gain when you sell it. So and you're going to convert to the U.S. fair market value. So if you sold it for Bitcoin, and at that time that Bitcoin's $10,000, that's going to be how much that NFT is worth. There is a market for them on OpenSea where you can look up values, but it's not live price like how a stock is or how Ethereum is. What is an airdrop? An airdrop is when you get deposited money or crypto or some other type of digital asset like an NFT without paying for it. Typically, this is viewed as income by the IRS. So for the other NFT that I own is VFriends. Gary Vaynerchuk put out this collection. You bought it, and every year for 3 years, you got airdropped, sent automatically to your digital wallet, a free ticket to go to his VCon, his business conference. So that's an example of what an airdrop is. What is DeFi? Decentralized finance or decentralized exchanges. We talked about this a little bit before. As opposed to a centralized one like Coinbase, there's blockchain protocols out there that, mimic and balance supply and demand. So if, let's say, Shiba or Dogecoin is very in demand and you're willing to provide to the decentralized exchange your Dogecoin because others are trying to buy it, the decentralized network will balance supply and demand and give you a payout for that Dogecoin that you gave to the protocol because it's providing liquidity so people can buy that token. Kind of like staking, it's a way to earn income through the cryptocurrency. And I have to throw this in here. I've seen so many people come into our firm losing money due to fraudulent scams, phishing scams, people saying, invest in this blockchain or send me your private keys or your password and I'll make money for you. Just be aware of scams out there. There's a lot of scam emails, phishing emails, trying to pretend like they're Coinbase and you changed your password. It's the unfortunate truth. We've seen so many people come into us, they've lost money to scams, and you're really out that money, and it's really heartbreaking to hear people falling for scams. So if you're getting involved in cryptocurrency, I highly recommend you get very educated on the do's and don'ts of what to do. Some basic stuff too, just never sharing your password, never doing things like that or falling, and making sure if you get an email from somebody, it's really who you think it is before you begin to interact with it. Or if somebody sends you a digital asset, you don't interact with it if you don't know what it is, to avoid any type of scams. There's with decentralized wallets, it's you're on your own in terms of protecting your cryptocurrency. Okay, now that the overview of crypto is done, let's get to the fun part. What is considered a taxable event in the eyes of the IRS? The IRS has a very low threshold for what is considered a taxable event. In fact, the first question on page 1 of the 1040 for the last 3 years has asked about digital assets. At any time during 2023 is the first question on the last returns we all filed. Did you receive as a award payment for property services, or sell, exchange, or otherwise dispose of a digital asset? See instructions. So if you received an airdrop, staking interest, if you received payment for goods or services, if you sold any cryptocurrency. Now, sold is a key word. What is sold or sell or exchange in the eyes of the IRS? Well, if you swap Ethereum for Bitcoin, or Bitcoin for an NFT, or an NFT for another digital asset, all of those are taxable events. You have to constantly figure what is the price you acquired it for. So if I bought, I have a good example on my next page here. The IRS counts each time you swap a digital asset, which what I was just explaining. So let's walk you through an example. Let's say you buy 1 Bitcoin for $20,000 on January 1st, 2022. And then you swap that 1 Bitcoin for 12 Ethereum on February 1st, 2023. The price of 1 Bitcoin is currently at $40,000. In this example, you have a long-term gain of $20,000 on the sale of 1 Bitcoin. Even though you never actually received the cash here, you have to recognize the sale because the IRS views it as property. So you're exchanging one property that you bought at a lower price for property that is now worth at a higher price. And this applies to if you use that Bitcoin to buy a car. You would still have to recognize that $20,000 appreciation gain when you swap that Bitcoin for another piece of property. So this is long-term capital gain of 20,000, and your cost basis in that 12 Ethereum is now that 40,000 divided by 12. So $3,333.33 per Ethereum. And just to go back real quick, because I'm not seeing any questions and I really want to drive this point home. This right here is probably still to this day the biggest thing and the biggest hurdle in terms of educating taxpayers of the consequences of what's involved when dealing with cryptocurrency. And the IRS doesn't really care that this is burdensome to people to have to calculate this themselves. If they're going to run up a lot of transactions, this is what needs to get done. And towards the end, we're going to go through some software that will help, streamline this, which is what we do for a lot of our clients. Using cryptocurrency as a form of payment. If you use digital assets to pay for goods or services, you need to recognize a gain or loss based on the increase or decrease in value when you purchase the digital asset to the time it was disposed to pay for a good or services. In general, these gains, losses are usually always capital gain or loss treatment, unless the taxpayer is in the primary trade or business function of digital assets. So that's like if you're in the if you have a trade or business in the digital asset space and you're buying and selling digital assets all the time, and you have an NFT project and part of it involves buying and selling, and you're in that business, kind of like a house flipper, where they're not going to recognize capital gain if they flip a house. They're in the business of flipping houses. That's ordinary income. So that's a position we take in for some of our taxpayers and clients that are in that space. But you got to be consistent with it. Once you select the method, you can't pick and choose based on when you have a gain or a loss in a particular year. And going back to my previous example, if you use that 20,000 Bitcoin that you acquired it for to buy a car or goods or services, if you use that to pay a very large attorney bill, you have to recognize a gain from the difference of when you acquired it to when you sold it. It could also be a capital loss. This is why some people have ignored their cryptocurrency, but they're actually leaving money on the table because they acquired it. Most people have been acquiring crypto when cryptocurrency gets hot and it's in the news and everyone's buying up digital assets. So there's times where they offload it. Either they trade it for something else and they trade it for something else, and they're incurring losses the whole way down that are not being used to offset their stocks and other capital gains. When is cryptocurrency taxed as income? Staking rewards, airdrops, or crypto received for services all considered income at the time of receipt. For example, if you earn staking rewards of 1 Ethereum valued at $2,000, this is considered income even though the asset was not sold. The $2,000 then becomes your cost basis in that Ethereum to determine gain or loss for when that Ethereum eventually is disposed. And again, that's either disposed for Bitcoin, cash, property, goods or services. That's when you'd recognize the gain or loss. But your cost basis is the income at which you receive it. So again, using a very basic example, which is not normally the case. Let's say you just received 1 Ethereum and at the time it was trading at $2,000. You have income of $2,000. As long as you have the ability to sell it, the IRS has put out revenue ruling saying as of 2023 that this is in fact income. Cryptocurrency subject to self-employment. Some cryptocurrency income earned, like cryptocurrency through mining or proof of stake, may be considered self-employment income. Speak to your accountant to go over the facts and circumstances of how the taxpayer earns income as it relates to digital assets to determine if it's self-employment income. We've seen this. We've seen people, buying up huge buildings, or they'll set aside half of their office to Bitcoin computers for mining. And there are expenses as it relates to it. And there's a certain amount of time involved in earning that cryptocurrency. So if a payment to a business is received in cryptocurrency, it is still income subject to self-employment taxes. Also, if you are an accountant and you get paid in crypto, that's income. The fair market value at the time you receive it's still subject to self-employment taxes. And then you'd recognize the capital gain or a loss. I see, excuse me, I see the other question. Does the IRS have a threshold, or is any trade subject to taxation regardless of amount? There is no threshold. There is no de minimis amount. Everything needs to be reported, whether it's gain, loss, or staking income. Excuse me. Paying business expenses in crypto. So this is special consideration for businesses. Paying for business expenses in crypto incurs as ordinary expenses based on the fair market value of the crypto asset at the time of the expense, plus a gain or loss that needs to be recognized on the disposed crypto used to pay a business expense. Need to also consider 1099 considerations and any other tax considerations like non-resident withholding, etc. So let's say, again, same scenario, I bought Bitcoin for $20,000 on January 1st, 2022. And I used that Bitcoin to pay a legal bill of $40,000 on February 1st, 2023. And the price of Bitcoin is currently $40,000. I still have my long-term capital gain of $20,000 on the sale of Bitcoin. And I also have an ordinary legal and professional expense of $40,000 on the profit and loss. Plus a $40,000 1099 NEC needs to be issued to the law firm at year end. So just because something is done in crypto, all the same rules apply. And it's important to consider all of these rules when dealing with cryptocurrency. That's why we started with understanding crypto. And if your accountant's in here wanting to handle this, I highly recommend buying crypto and being familiar with it. You don't have to buy a lot of it. That's the beauty of crypto. You could buy $1 worth and buy it on Coinbase, send it to MetaMask, send it to a ledger. You have to buy a ledger. You don't have to buy it, but you could start with at least getting a Coinbase and MetaMask account set up and working with it, moving money from exchange to decentralized wallet back to exchange to understand the nature of how these things work, to best understand and communicate the tax rules, which we all know, to our clients. So how are taxable events reported? Well, back to that question, very low threshold. You're going to have to check yes if they received it. There are only really two exceptions to getting out of checking that box. Is if you bought crypto with US dollars and you only had self-transfers. You never sold or disposed of anything. But even self-transfers come with a gas fee usually. So, which is a small disposal of cryptocurrency with zero consideration, which would be a small capital loss. So again, very low threshold. If your clients or you're a taxpayer and you're listening, generally you're going to be subject to checking this box if you're involved in digital assets. So generally, we keep talking about gains or losses. You will need Form Schedule D and 8949 to report those gains or losses for cryptocurrency transactions. A key component at the time of this presentation is there's no wash sale rules like there are with stocks. Again, we discussed in the beginning that cryptocurrency is property, not securities. Therefore, they're not subject to the wash sale rules. So if, let's say you bought Dogecoin when, back when it was really going crazy, and you think coming up now, which a lot of people have been saying that, crypto's going to go up again. They talk about the Bitcoin halving cycles and all these things, but you're sitting on a lot of losses. Now's a good time to sell those cryptocurrency. And if you really truly believe in it, you could buy it back and you can claim that loss for tax purposes without the disallowance of a wash sale rule. Now, the flip side is you have a much lower cost basis when you go to sell, but you can use that capital loss this year to offset other capital gains like sales of real estate, stocks, etc. Other income like airdrops, staking rewards, miscellaneous rewards, other income that is not self-employment income will be reported on Schedule 1, Line 8Z. That's not subject to self-employment. Self-employment income will be reported on Schedule C and or Schedule E, or for flow-throughs like partnerships and S-corps, less the applicable business expenses. So again, same forms that we've been using for everything else. We're just taking what's going on in cryptocurrency and sticking it in the form and the boxes where it belongs based on how the IRS sees everything. Okay, my favorite part of the presentation. What happens if you fail to report your cryptocurrency to the IRS? These are the notices that we are seeing people come into our office with, and they are scared, confused, and they don't know what to do. And this 66,000 is not even the highest we've seen. We've seen millions, we've seen hundreds of thousands. We see 10,000, we see 2,000, we see all sorts of numbers. This is a risk of a matching notice. A Form CP2000 the IRS will send showing proceeds of transactions that they know about with a cost basis of 0 and a proposed amount due. This is an automatic notice. It's not an audit. The taxpayer then has 30 days to calculate the cost basis and respond. All taxpayer prior year transactions need to be reconciled to properly calculate the cost basis for each transaction. This is an example of what they send. So you see here, this taxpayer in particular had sales, disposals of Bitcoin, and they're showing the total proceeds reported by others. The taxpayers do not report it, but they show no cost basis. They're showing a full 59,755 proceeds of the Ethereum, and the IRS is not going to assume any cost basis for you. The other issue here is these may be self-transfers. These may be transfers from one exchange to another. But if you don't have the proper documentation to show to the IRS that this was not a true sale, you're not going to be able to fight this notice. Also, you need to calculate your cost basis because the IRS is just going to assume it's all proceeds. And they'll happily accept your money if you agree to this, but you have to then go back, file the Schedule D and the Form 8949. You have to make sure your proceeds agrees to the total amounts reported by the IRS, or at least ensure it's greater than, and then have the cost basis set up for each of these transactions to properly support what the gain or loss really is. Now, the IRS will accept the Schedule D and the Form 8949, but sometimes an amended return is warranted in terms to address the CP2000 notices. And we're seeing a lot of these. They just got through 2021. We're starting to see 2022 CP2000 notices. And this is only going to become more prevalent and more of a scary notice that taxpayers are receiving because of this form right here that they are coming out with. This is Form 1099-DA. And this form is going to be requiring exchanges like Coinbase and others. It's basically looping, in short, more exchanges into reporting the proceeds to the IRS of certain transactions. Now, this is still early on. And from my understanding at the time of this recording, they're eventually in 2026 going to require cost basis. But these exchanges, and going back to the notice for a moment, these exchanges don't know your cost basis. If you take cryptocurrency, buy it on Coinbase, you send it to MetaMask, and then you send it to Ledger, and then you send it to Gemini, and then you sell it. Gemini has no clue what your cost basis is because they can't see into all those platforms. So this is where it falls on the taxpayer and us as accountants to help our clients accurately calculate their cost basis and track their self-transfers, which are non-taxable events, in order to properly file their taxes, their Schedule D, their 8949, their Schedule 1, and include all of the transaction gains and losses so they don't get these matching notices. I see another comment in here. Correct, the IRS already has all their information. If concerned, your client has taxable crypto transactions, run wage and income transcripts on them. That's also a good idea. The wage and income transcripts are only going to alert you that you're going to have to do the full calculation. Chances are the IRS won't have all of their crypto history, but in order to properly file their crypto taxes, you need to know all of their crypto sources, their exchanges, their wallets, all the exchanges and wallets they don't use anymore, but that cost basis can carry over if they self-transfer that crypto to a new platform. All right, so how do we do all this? This is a lot to handle. How do we get started on it? Well, we use software for business and personal in order to create these reports and crunch the numbers. We use Zenledger as our preferred software for personal. Zenledger can also be used for business, but for more advanced businesses, we use Bitwave. That is a full-on cryptocurrency accounting platform that can have journal entries and integrate within QuickBooks and other accounting softwares. Zenledger, primarily for individuals, is what we use. There are a lot of other cryptocurrency softwares out there. These are just the ones that we use at our firm, and I encourage you to do your own research. But again, these softwares don't do everything for you. These softwares are a tool for crunching the numbers, calculating cost basis, and running the transactions. But similar to doing QuickBooks for clients, a lot of it's going to come down to the input, and it does take time to go through, review all the transactions, and reconcile. I'm going to walk you through now the steps of what's required in order to make sure we prepare an accurate crypto tax report. So calculating crypto taxes, again, I mentioned before, the taxpayers got to link all their wallets and exchanges that they've ever used in the cryptocurrency software. So Coinbase, all of their wallets by blockchain, if they have cold storage, that needs to be linked, because we need to make sure all of the cost basis carrying forward to future years is considered, as well as self-transfers, because the IRS may see cryptocurrency leaving one platform, but if we can link it up and show it left Coinbase and came into MetaMask, that is a non-taxable event. And those are things that you can document in these cryptocurrency softwares, as well as the income from staking, airdrops, mining, anything else that you got paid for using crypto, and the gain and loss component. Think about this like QuickBooks for crypto. You have to go in, you got to make sure the US dollar amount is correct in that USD value column. And you got to make sure we got the right category here. We have cryptocurrency coming in, a deposit, 25,000, that's income. They swapped the QI for USDC, and then the USDC was sent out. So the outgoing is going to be treated as a sale unless we have the ability to match this up with another digital asset, or maybe it's a staking lockup. You need to give this the correct categorization in order to properly have the software crunch the numbers and come up with the gains and losses and determining what transactions are taxable and not taxable. As you can see, there are several categories to pick from. You can pick a blockchain fee, a gift. You can mark it as ignore. Ignore is generally used for transactions where maybe there's a duplicate in there, or maybe there was spam sent to it. That happens a lot with decentralized wallets. People send nonsense or NFTs that are malicious, where if you interact with it, it can steal the money out of your wallet. So you mark those ignore in the software because those were not real transactions. You can mark it as purchase if you spent that crypto on a car, like we were talking about earlier. Marking it as a self-transfer allows you to link it up to another transaction. Staking lockup is where let's say you take that 32 Ethereum that we were discussing before and lock it up to earn rewards on it. A switch trade is where you mark up where you sold one digital asset for another, like that middle one where it says trade, switch trade, the QI was swapped for USDC. Now on the deposit side, you can mark them as interest, mine, miscellaneous reward, or also income. Those are the small rewards if you've ever used Coinbase, where they give you a learning reward for learning about different digital assets. switch trade, staking return. So when you lock up that 32 Ethereum to earn staking rewards on it, income, interest, and you withdraw that 32 Ethereum, that's not a taxable event either. So that's a staking return of your principal. The staking rewards are taxed as income. And you can also there's a mark as payment category if you get paid in digital assets for any of your services. The cryptocurrency software is very good. Again, these are all screenshots from Zenledger. They allow you to calculate the crypto in any of the permissible methods: first in, first out, last in, first out, highest in, first out, or average cost basis. And you can also, once you're done doing the reconciliation process where you confirm the USD amounts are correct, you give everything the correct categorization. And again, you did the first step where you started with adding all your exchanges and wallets. If you don't have all your exchanges or wallets added, the categorization process is not going to be complete. But at the end here, you can download all your forms to include on your tax return: the Form 8949, the Schedule 1, the Schedule D, Schedule A if you did any charitable donations in crypto, Schedule C if you were doing mining activity, and so on. And they have more specific forms, specialty forms as well. Again, Zenledger is not the only crypto tax software out there. There are many crypto tax softwares out there. But again, you need to, it's on the taxpayer as well as their accountant that they're working with to review the inputs to the software. You can't just upload it and assume it's all done in 5 minutes. That if you do that, it's not going to be correct. They may certain platforms may advertise that, but it's not accurate. This stuff takes time to go through, and you may be going through just to backtrack certain transactions, and you may see like a USDC is leaving, it's outgoing. But thinking back to the year, if the taxpayer is looking at this, they may say, oh, well, I never had such a big sale. I sent that to MetaMask. My MetaMask wasn't added to the import screen, so it's not matching up as a self-transfer. So there's a little bit of back and forth involved in here in terms of categorizing things and cross-referencing back to what's been imported to ensure all of the transactions for the taxpayer are in here to properly calculate their gains, losses, and income from cryptocurrency. So in closing, take digital asset reporting seriously. Don't ignore it. It's the first question on the tax return for a reason. And if your clients say they have crypto, make sure you really press them and try and help them by saying, listen, we don't want to have you get an IRS matching notice CP2000 because they are increasing. And the broker requirements Form 1099-DA coming out next year will only be increasing the amount of automatic notices that the IRS sends out. If your client says, I did not sell anything, explain how cryptocurrency taxation works. They likely have taxable events, or they may not be aware of how the IRS treats sales for purposes of taxation in the IRS's eyes. And use the current rules to your advantage. No wash sale and maximizing your capital losses where you can. We help taxpayers, personal and business, with the digital assets, and for accounting firms to have clients invest in digital assets who need help. We work with a number of accounting firms to handle the cryptocurrency tax part specifically. So we're always happy if you reach out to ask us questions. If you're watching this webinar, reach out. Happy to help you. Or if it's something where you just want us to handle and send you the reports, we can maybe do that as well. But we're here to help. And with that, contact info, social media info on the screen. I'd love to take any questions that you guys have.
Hey, Justin, looks like we got a question earlier from Rachel who says, what should a taxpayer do if they have had cryptocurrency in the past and never reported it on their tax return?
That's a great question. I would say for that, get started with a platform. Let's say they bought it in 2020. You have to go, in order to file it for the current year correctly, you always have to go through and file and figure out your cryptocurrency gains, losses, and income from the years prior. Because we don't end the year where we liquidate all of our crypto before January 1st. So there's cost basis that rolls over. So in order to get 2024 correct, we need to know what happened in the prior years. And once those prior years are done, you can have a conversation with your accountant and decide which of these years are we going to go back and amend. Is it significant where we understated our income, or are there $30,000 of capital losses that we should amend and carry forward because that's a big future savings to the client if they sell stocks or crypto in a future year to carry forward those capital losses. I think we got another one in here. Can you also use the sale of specific lots for your cost basis if you keep wallets separate? So that you can use specific identification. There are new rules coming out that you cannot use one universal wallet. It's my understanding that the cryptocurrency softwares do track on a per wallet basis. And if you're using HIFO or LIFO, you need specific identification for the tax lot, which these tax softwares do, at least ZenLedger does, to our understanding. I see another one in here. Once a year for the last 3 years, I've purchased Bitcoin to pay a vendor who's required that form of a payment. There's usually just a few American dollars worth left over once I make that payment. So I just give it to a teenager, just verifying that neither is a taxable event. No, that is a taxable event. So if you are buying Bitcoin to pay your vendor, you're going to have even if you buy it and send it immediately, you're going to have a small gain or loss, and it's reportable on your tax return. So you don't want the IRS seeing that this transaction occurred without the proceeds and cost basis reported on your 8949 Schedule D. And if you give crypto to somebody without any consideration, you have a small taxable loss if you give somebody $1 worth of Bitcoin. So you should also report that on your 8949 Schedule D, as well as you should take the expense, which I'm going to assume you are, for the value of the Bitcoin at the time you send it. That is what it's worth, is your expense. So again, going back to my example, if I buy Bitcoin for 20,000, it goes up to 40,000, and I pay a legal bill, my legal bill is 40,000. But chances are when the Bitcoin's sent, it's not exactly 40,000 even. So it's $40,001.18. Yeah, sure. No problem. Happy to help.
I see one from Evan. Evan wants to know, what action should taxpayers take if they received a tax notice from the IRS related to cryptocurrency?
Yeah, so the first thing I would do is call the IRS up, ask for a month extension of time, because 30 days usually is not sufficient, to go back years and crunch your cryptocurrency, and get knowledgeable on the IRS rules even before you reach out to a professional. Get familiar with the IRS rules, understand what's being asked, and then understand the amount of time that's going to take to crunch the numbers once you start using a software, and then reach out to a professional to see who's in your budget to best help you crunch the numbers, file your cryptocurrency, and hopefully that professional as well. What we do with our clients, once we get them caught up to speed on a prior year, we can then do some go forward planning and see what they're holding, see what we could sell for a loss, and begin to use the tax rules to their advantage. But get started, call the IRS, ask for a brief extension of that notice, and get started calculating your cryptocurrency in one of the crypto tax softwares.
Great. That's everything I'm seeing now. So I just want to thank everyone for attending. I'm going to thank Justin. And here's a quick reminder on how you could earn CPE for attending today's webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.